Disney, Advanced Micro Devices, and Super Microcomputer are among the stocks reporting earnings this week. My next guest uses AI to make projections on earnings. Let's find out more. Joining us is Doug Clinton, founder and CEO of Intelligent Alpha. Thanks for joining us today.
Thank you, Marilla.
Let's talk about the process first, if you don't mind. Remind us how the AI does this.
So what we do at Intelligent Alpha is every single quarter, we look at over 1,000 different publicly traded stocks, US listings, European listings, Japanese listings, and we have our AI system estimate whether it thinks those companies will either beat or miss earnings in the coming quarter. Just to give you a little perspective, we look back to the Mag 6 that kind of reported for the most part last couple of weeks. We had a pretty good track record. We got Apple, Meta, Microsoft, and Google right. We owned the latter of those three. We had some concerns about Amazon, and we turned out to be right on that one, although we thought it'd be more on the revenue side than earnings. We also had some hesitancy around Tesla, that we thought that investors would ultimately look past some of those concerns about auto growth, and I think that that has largely played out.
Let me ask you a little bit further about the process. So you mentioned that you look at 100 stocks, let's say. You take past earnings reports, I imagine. Do you also, or does it also, factor in news stories?
We do. We use multiple different signals when we have our models look at these companies. So we do pipe in historical financial information, how things trended on the balance sheet, how things looked on the income statement. What also has been management commentary from the past quarter in terms of their guidance and then what they're seeing in the business. And then we also do pull in some recent news events to give the models some flavor about what's happened between the last quarter and today.
Okay, so is it ever way off?
What we do right now is we really are just looking for kind of a binary decision. We're looking for a meet or a beat or a miss, right? So we're not giving the models hey, please predict exactly what these earnings will end up being. We do ask for magnitude, so we might see things large, medium, small. But because we're trying to constrain the game, basically, that we have the models play, there's not really an opportunity for the models to be, way off. And we're looking for this directional accuracy. So in our investment products, we can kind of place bets across a lot of these companies that we do the estimates for. Okay,
so let's go through one or two of them. Advanced Micro Devices, your AI models say buy. Does it, you mentioned you're sort of looking for an outcome like that. Does it give you sort of reasons as to what led it there?
So for AMD, this of the three we'll talk about today, this seems to be the one the models are the most confident in. And so the models expect AMD to post strong revenue and strong earnings. And some of the rationale is on the AI side. I think that AMD, if you look back just over the past year, their story has been challenged on and off. I think there's been this sort of persistent hope that AMD would be this competitor to AMD. They'd be able to take a little bit of share and build a really big AI chip business selling to the hyperscalers. And that just hasn't really panned out so far. They did about $5 billion in AI-related revenue last year. And I think the models now are a little bit more bullish, a little bit more optimistic that the new chip launch, MI350, which just came out in June, might help start to accelerate some of the revenue progress that we're seeing at AMD. And I think if that does happen, investors will react favorably.
Okay, let's get to Super Microcomputer. Your AI sees some mixed signals. Let's dive into that. What does that look like?
It does, and it's a little scary because we also own the stock. So our models, despite the sort of mixed signals that they have for earnings, still think this is a stock that they want to own. We own it in our Livermore ETF LIVR. But what the models are seeing here is sort of a mix on both revenue and earnings. And so the way that we do our process is we actually use multiple different models to look at both revenue and earnings. We use most of the large closed source models like GPT, Gemini, Claude. And we're not seeing a very strong consensus on either side. We're seeing some of the models feel that the revenue and earnings will be fine. Some of the models think that there will be a miss. And so as we go into this quarter, it is a position size that is, reflective, I think, of some of that hesitancy. I think the big question for Supermicro has been, is there any sort of fall off or tail from some of the issues they were dealing with last quarter or even last year when they had some delisting concerns, when they had some concerns about audit processes and things like that. Will that ever flow through into a business impact? And I think this quarter might tell us that story.
Okay, let's get to Walt Disney. AI saying beat on revenue, mixed on earnings. What more can you tell us about that?
It is. So Disney is actually a stock that we don't own in our funds, but I thought it'd be one that viewers would be interested in just because of the brand and the market cap of it. The reality is, again, we've got a situation where the models feel pretty good on the revenue side. I think the streaming business in particular has been obviously good for Disney. On the earnings side, that's where we're seeing, again, this kind of lack of consensus. A few of our models are favorable on earnings, and then there's some perspective also that there may be a little bit of an earnings concern here. And I think if there were to be some sort of concern, maybe it is just some flow-through investment into things like streaming, which obviously is a big growth business for Disney, but given their competition, like Netflix, obviously spending a lot of money to keep their lead, Disney might need to spend a little more to keep up. And so our models are really, I think, looking at that earnings number more this quarter relative to revenue.
So let me ask you whether, Doug, you think that AI has improved your information, sort of has it boiled things down for you in a way that is positive for you? And moving forward, what more do you expect from AI?
We do think it's been quite positive for us. I mean, at Intelligent Alpha, we've been basically doing this now for 2 years, and we've seen an incredible evolution from, I mean, way back in 2023 when we started. You know, the model was GPT 3.5. We've come a very long way from there. And Sam Altman has this quote about, you know, whatever AI model you are using right now is the dumbest model you'll ever have to use. And we've seen that in the history of, you know, how these models have performed in all of the strategies we track. And just to give you a reference point, you know, we track almost 36 different strategies at Intelligent Alpha. Some of those are in available investment products. But the TLDR is the vast majority of those, 80%, have outperformed their benchmarks that we comp them on since inception. And so we think these models are very capable today as investors. We think they're pretty good at looking at some of these earnings and making projections and investments around that. And we think they'll only get better from here.